Okay, we're still in commissioner questions. Commissioner Belser.
Good morning, Mr. Parcell. How are you?
Good morning. Fine, thank you.
There was some questions and responses about a letter from ORS. I'm not sure when it was. Today, Friday, whenever. And a 9.76%. Is that correct?
Correct.
And I just wanted to understand, in response to questions from Ms. Counsel Ellerby, you started saying where that was in your range or in your study. Could you repeat that for me? I couldn't follow exactly
Certainly.
What was being said there, or didn't follow. And I understand this is, I don't know, and I think this is in the nature of some sort of agreement or something. I don't know, with some of the parties, but I'm just trying to understand, or an offer. I'm trying to understand if this, if and where this is in your range. I think you started talking about that.
The simplest way to answer your question is to refer you to page 4 of my direct testimony.
Okay. Thank you.
At the top of page 4, I have a little table, and you can see the comparable earnings range is 9.0 to 10.0, and I selected 5, the midpoint of 9.5. But the 9.76 is within the 9 to 10% CE range.
Okay. And tell me about the comparable earnings study. I don't believe Mr. Hebert did that study. Is that correct?
That is correct.
All right. And tell me how that, just generally how that study is conducted, and why you chose to use that study.
Okay. I've been using that study since 1972, so it's always been in my testimony. What I do, I look at the experience returns on equity for the electric utility proxy groups, assuming it's an electric case like this here. And I look at the last 2 business cycles, the last full cycle, which is 2002 to 2008, and the current cycle began in 2009 and up to the current time. So I look at the earned returns on equity for those 2 cycles plus projected returns on equity according to value line for 2020 and the period 2021-23. So I look at those returns on equity to see what utilities have earned and are expected to earn. And to test the adequacy of those, I look at market-to-book ratios, because utilities are regulated based upon the book value of their assets and liabilities. Rate base is a book value. The capital structure is a book value. So if you have rates based upon your book value, you would think the stock price for a company earning its fair rate of return would be 100%. Market would be book. If the achieved earnings were inadequate, the market book would be less than 100%. So to test the adequacy of the past returns, I looked at market book ratios, and I found that they were well above book, meaning that the past returns were more than adequate to maintain the company's cost of capital and its fair rate of return.
Okay.
And that's how I used comparable earnings.
Why is the CAPM so much lower than the other methods you used?
Since the Great Recession started in 2008 and 2009, the Federal Reserve has, through the short-term rates they handle, they pushed down the discount rate, and through what was referred to as quantitative easing, where the Fed bought billions upon billions of Treasury securities every single month to keep the cost of long-term debt down. They depressed the cost of Treasury securities, and because those Treasury securities were, back up. The Fed owns trillions of Treasury securities now purchased. They're starting to sort of unload them, and although they've announced just last week they're going to stop doing that now as well. But since the Treasury yield was kept artificially low, if you use the risk-free rate of low, which is artificially low, you get a lower return. And that's why the CAPM has been lower since then. And I have not, in fact, even though I do CAPMs, it's not reflected in my range because of those reasons.
Okay. Why? I know that Duke proposed the hypothetical capital structure, and you use the same capital structure. Is that correct?
That is correct.
Why are we using a hypothetical here, not an actual?
Duke tends to use is so-called optimal. That's the term they use. Optimal capital structure in its rate cases, and 53% equity seems to be the norm. I have a schedule in my testimony as part of DCP-2, schedule number 5, page 1. And that shows the actual end-of-year capital structures of Duke Energy Carolinas for the period 2014 to 2018. And if you focus on the numbers that do not include short-term debt, which is the second set of ratios for each year, you'll see that for the last 3 years, in 2016, the equity ratio then was 53%. 17 was 55.9, 18 is 51.5. So from their perspective, the so-called optimal is about what they've had.
And since you accepted that, is it fair to say, now I don't want to put words in your mouth and you can disagree and explain, but is it fair to say that you found that hypothetical capital structure to be reasonable for use in estimating a return on equity?
It's a little on the high end, but not enough that I'd make a proposed adjustment in this proceeding.
You started talking about your beta that I believe was in your SIR rebuttal testimony, and I just didn't understand everything you said. You indicated that the market for the beta is 1, and then you started explaining about a beta of 0.4 or 0.6. And could you go over that again?
I'd be glad to. This is on page 7 of my SIR rebuttal testimony. Here's what beta is. I'm going to give you a simplified version because there's a technical, statistical version which I have not even committed to memory myself, but I'll give you the Reader's Digest version. Beta is a measure of how the volatility of the stock price of a particular stock compares to the volatility of a market. And the market is by definition 1.0. That's your measure. There are different ways of calculating beta. The most common is to use the S&P 500. So for the purpose of discussion, let's just look at the S&P 500. So the market as a whole has a beta of 1.0 because the market is the market. For any particular stock, if that stock is more volatile than the market, its beta is greater than 1. If it's less volatile than the market, it's less than 1. And the whole concept of so-called modern portfolio theory, a portion of which is the capital asset pricing model, is that beta is a measure of systematic risk, and therefore it shows how a particular company's risk compares to the market through its beta. And what I have shown on page 7 of my cerebral testimony, at the bottom of the table at the bottom, the second set of statistics, which is called value line beta, I've shown that between 2014 and 2019, the betas of my proxy group have gone down from 0.72 to 0.54. Mr. Hewitt's average company's betas have gone from 0.76 to 0.60. In Duke Energy's is from 0.7 to 0.5. That shows you the utility stocks over that 5-year period had declining betas, which meant that their stocks' volatility relative to the market today is even less than it was 5 years ago, which reflects the lower risk that utilities are facing for a myriad of reasons, some of which would be the fact that they're a safe haven, and the fact that many utilities, including DEC, are employing more and more regulatory mechanisms now, which takes the uncertainty out of rate cases. They collect more revenues from these mechanisms, and the market recognizes that.
Thank you very much. That's all I have, Mr. Chairman.
Thank you. Other commissioners. Commissioner Whitfield.
Thank you, Mr. Chairman. Mr. Parcell, you talk about in your testimony using the when you talk about the cost of common equity, you use the DE and the DCF and get a range of 9.1 to 9.5, correct?
Yes, I used the DCF and CE, or comparable earnings, yes. DCF and CE, correct.
And in your recommendation, you're just using those two, and as you said, you didn't use the CAP-M, which you just very adequately explained to Commissioner Belser about the CAP-M.
That is correct. At least the first part. I'll let you decide how adequate my answer was. But the first part, yes, I did not use a range.
All right, sir. I think it was pretty adequate. To follow up where you were with Commissioner Irvin a little bit ago, you had a discussion with him, and you talked about the Great Recession in 2008, and then you really kind of focused a lot of your exchange with him about from the third quarter of 2018 and the cost of debt going forward now. What I wanted to kind of follow up with you on, and he kind of sort of went in this direction early with you, but why have the average ROEs continued to decline while the economy and equity markets have largely recovered? I'm going back to the Great Recession. Now, you explained some of it from 2014 just now to Commissioner Belser to now, with it being things being less volatile and people wanting to invest in something that's less risk, as you use with the explanation of beta. But with the markets continuing to recover and continuing to recover up until the third quarter, as you said, and then that big drop at the tail end of 2018, why have ROEs continued to, in your opinion, why have they continued to decline?
Yeah, good question. We have two different concepts here. If you look at only the change in stock prices, that's a so-called market return. If you were to purchase a stock today and held it for 1 year, a year from now, if you said, what is my return, you look at two factors to determine your return. Suppose you bought this stock for $100. A year from today, you'd say, well, during the past year, I earned $1 in dividends, and the stock is now worth $104. So my return for that year is $5. $1 dividends plus $4 increase in price. So I would have had a 5% return on that stock. That's the market return. Return on equity is a book figure. It looks at the earnings from the income statement of the company, the book earnings, and divides them by the common equity from the liabilities side of the balance sheet, which is also a book figure. And so that's a measure of how a company's book earnings relate to its book equity. And they're two different measures of return, and that's why I use both of them in my CAP-M. And the DCF uses the market return part, and the CE uses the book return part. So they're different concepts, and I use them both, but in different ways.
I see.
Is that?
Yes, sir. Back to long-term debt is still your opinion going forward with the exchange. You know, I'm kind of going back to your exchange with Commissioner Irvin that I guess what you're testifying or what you're saying is the company's cost, as you see it in the near future, are going to be lower because of the possible decreased cost in long-term debt. And then you made a statement, if that debt had already been sold or issued, then I guess you didn't quite use this word, but I think you were saying locked in.
Yes, two questions there. First of all, I don't predict debt cost. If I could predict debt costs, I'd put on my little visor and get my computer on and make a lot more money for a lot less grief than I'd be doing sitting here.
Right, the Fed.
But I can show trends.
Right.
Now, in my rebuttal testimony on page 4, I showed that the actual average weighted cost of debt for DEC has declined from 5.50% in 2014, right after their last rate case, to 4.53% today. So its actual cost of debt has declined by 100 basis points since its last rate case. On page 5 of my rebuttal, I point out that the average yield on new utility debt, AA, has declined from 4.19% in 2014 to 4.05 as of February. That's a small change, but it's still a decline as opposed to increase. So on a current and going forward basis, the company's cost of debt is not likely to increase. If it's sold that, they'd probably come down just a little bit.
And I think you cited us those numbers a little earlier, and I thank you. That's all I have, Mr. Chairman.
Thank you. Any other commissioner questions? Commissioner Belzer. Your mic's off.
Thank you. Looking at that table that you just referenced on page 4 of your rebuttal, with the weighted average cost of debt showing for 2018 4.53%.
Yes.
And yet you've used 4.44% in your calculation on return, rate of return. Why the difference?
Okay. In the company's actual application, it used
4.63, I believe it was.
right. And what I said, now bear with me, it's just not simple to grasp. The company used its cost of debt in the application as of December 31, 2017. And a portion of what was long-term debt at that time was scheduled to mature in 2018. And I says, and my point was in my direct testimony, is that the debt that's maturing is going to be refinanced. And it truly was long-term at 12/31/17. It's just accounting-wise, you call it long-term debt due within 1 year, so you move it over to short-term. So my 4.44 was just reflecting the refinancing of the maturing debt. In its rebuttal position, the company says, well, Mr. Parcell, we don't disagree with the idea of updating the cost of debt, but let's update it all. They said 4.53, and I said, fine. I had no. So in my current position, it is 4.53 as shown in the rebuttal position of Mr. Sullivan.
Thank you very much.
Mr. Chairman,
Commissioner
before we
Williams.
close this session, I have a couple of questions for Mr. Porcel. Earlier during this hearing, we had testimony from the company that essentially amounted to a rate of equity at 9.3 being unfair to the company, that it could potentially cause an increase in what ratepayers would have to pay because the cost of capital would go up. Investors may be reluctant to invest in the company because the return on investment is just not there. And so I'm interested in your opinion as to what could be the outcome for the ratepayer. What would happen on the market if this commission decided that a 9.3 return on equity was appropriate? Would there be some type of doomsday scenario for the company?
On my schedule, paper clips it away. My schedule 11 of DCP-2, I showed it earned returns on equity of Duke Energy Company since 2002. Duke Energy has not earned as high as 10% in any of those years. It's projected to earn 8% in 2019, 8.5% in 2021-23, yet its market-to-book ratio is over 130%. So investors are valuing the stock higher than its book value, even though it's earned returns lower than I'm proposing. So we're not talking about the return on equity earned going down. I'm proposing a higher return on equity they've earned.
Thank you. Any other commissioner questions? Mr. Nelson, any redirect?
Mr. Parcell, Mr. Ellerby had focused on two recent orders of this commission discussing ROE. In one case, making actual finding at 10.5, in the other case, basically approving what it felt was a 10.75%, even though that wasn't what was awarded. Based on your analysis of ROE awards across the United States in 2017 and 2018, and I would refer you to your exhibit DCP2 Schedule 3, do you believe that these findings and awards are in line with ROEs in other United States jurisdictions?
No. With one exception of a case that I happen to be in, and the utility that serves Juneau, Alaska. In case you don't know, Juneau is the only state capital in the country that you can't drive to from the rest of the states. You have to get there by boat or plane. The utility that serves Juneau is not connected to anybody else. They get all their generation from one hydroelectric plant. They cross, and the transmission line crosses a mountain. And let me tell you, when a transmission line crosses a mountain in Alaska, you've got a potential issue. So they have to have a backup power in case the transmission line fails. That one company had a settlement of like over 11%. They asked for 14.5%, by the way. Other than that, there's not been a single utility ROE award as high as 10.75 in the last 6 years in the U.S.
Thank you.
And it's been at least 25 or 30 of 9.5 or below, including some that are integrated, including Dominion. And I was in a case last year, Public Service of Oklahoma. They got 9.2 as well.
And you brought
9.3.
You brought up Dominion, and you testified earlier regarding, in an answer to a question from Mr. Ellerby, regarding the Virginia Commission's award in a Dominion case up there. Are you familiar with Mr. Hevert's testimony regarding his proxy groups?
I'm sorry.
I'm going to refer you to page 17 if you have it, and I can bring it up.
I don't have his testimony with me.
Handed you a copy of Mr. Hevert's testimony that was pre-filed in this case and referencing Table 1 on page 17 of his direct. Does he use Dominion Energy in his proxy group?
He did not.
Okay. And is there any reason why he would exclude Dominion?
Well, the simple reason that would not meet his criteria, according to him.
Okay. And his criteria, is he looking at companies across the United States, or is he focusing more on southeastern United States utilities?
Dominion has a fair amount of non-regulated activities. It has a big coal gasification facility in Maryland, and it is more than sticking its toes into the natural gas pipeline construction right now, which is encountering some issues. So he may have not included them because of their equity, because the portion of revenues or income attributable to electric operations were less than his threshold. I'm just speculating.
No further questions. Thank you, sir.
Any recross?
briefly, Mr. Chairman, and I mean it. Mr. Parcell, Mr. Nelson was asking you to explain why Mr. Hebert may or may not have included the Dominion cases in his proxy group. Would Mr. Hebert be the right person to ask that question? I
would.
Yeah, and you understand that he's going to be here on Wednesday to testify to the commission. And he also is probably in a position to explain this Virginia order that Counsel for Walmart asked you about also. You think Mr. Hebert knows about that?
You say explain the order. The commission's order, like you so eloquently described to me a while ago, the order speaks for itself.
Well, but
I mean, you can't both ways.
That's right. But
if you're going to torture me, you got to torture him with me.
No, but you were asked a bunch of questions about it, were you not?
Yes.
Okay. And Virginia has adopted different approaches to rate regulation of utilities that allow for base rates and then other subsequent proceedings on narrow issues that are more complex or different from what we have in South Carolina. Is that correct?
Your question's not quite right. May I help you? So, do you mind?
Have at it.
The Virginia legislature has created circumstances where certain types of projects and construction and things of that nature have to be granted an adder to the return on equity for those specific projects. That's the legislature. The commission did not do that. Right. And I don't want to be cute with you. I'm just saying, you said commission. The commission had nothing to do with it. They were heavily opposed to it.
But in this order that you were asked about, the commission was setting the base ROE to which those other things are added.
And that's the portion of, that's the ROE that most customers' rates, including me, I'm a customer, that most people's rates are based upon is the base ROE, and that is 9.2.
And Mr. Hebert is familiar with those, and that may have impacted, as far as you know, and I know, that may have impacted Mr. Hebert's decision on whether to include VEPCO or Dominion in his proxy group. Is that right?
Don't know.
Nothing further, Mr. Chairman.
Thank you. Okay, Mr. Parcell, we appreciate your testimony. Thank you for being here, and you are excused.
Sure.
Okay. Who's next?
I believe we're back to company's witnesses at this point.
Mr. Chairman, the company would call John Karen and Dr. Wright as a panel. Thank you. Good morning still, I think, Mr. Karen. I'll start with you. Will you please state your name and your business address?
John F. Karen, 411 Fayetteville Street, Raleigh, North Carolina.
By whom are you employed and in what capacity?
I'm employed by Duke Energy Business Services, and I'm the Vice President of Operations, Maintenance, and Governance for the CCP Group.
And would you tell the Commission what CCP means, sir?
Coal Combustion Products.
Did you cause to be pre-filed in this docket on November 8, 2018, 38 pages of direct testimony in question and answer form, and an appendix consisting of 38 pages, and 10 exhibits consisting of 451 pages?
I did.
Did Did you cause to be filed in this docket on January 23, 2019, an errata to your direct testimony?
I did.
Do you have any changes or corrections to that direct testimony or these exhibits?
No, I do not.
If I were to ask you the same questions that appear in your direct testimony today, would your answers be the same?
They would.
Did you also cause to be pre-filed in this docket on March 12th of this year, 22 pages of rebuttal testimony in question and answer form?
I did.
Do you have any changes or corrections to that rebuttal testimony?
No, I do not.
If I were to ask you the same questions that appear in your rebuttal testimony today, would your answers be the same?
They would.
Mr. Chairman, at this time, I would move that the pre-filed direct and rebuttal testimony of Mr. Karen be copied into the record as if given orally from the stand.
Mr. Karen's pre-file direct and pre-file rebuttal testimony will be entered into the record as though given orally from the stand.
Mr. Chairman, I would also ask that Mr. Karen's exhibits be marked for identification and entered into the record as a composite.
Mr. Karen's exhibits will be marked and entered into the record as exhibit number 29.
Now, Dr. Wright, to you, sir, would you please state your name and business address?
Julius A. Wright, 18 Edgewater Drive, Cartersville, Georgia.
By whom are you employed and in what capacity?
I'm the president of J.A. Wright and Associates.
Did you cause to be pre-filed in this docket on November 8, 2018, 28 pages of direct testimony in question and answer form and one exhibit consisting of 16 pages?
Yes, I did.
Did you cause to be filed in this docket on February 11, 2019, an errata to your direct testimony?
Yes.
Do you have any changes or corrections to that direct testimony?
I do not.
If I were to ask you the same questions that appear in your direct testimony today, would your answers be the same?
Yes.
Did you also cause to be pre-filed in this docket on March 12th of this year, 39 pages of rebuttal testimony in question and answer form?
Yes.
Do you have any changes or corrections to that rebuttal testimony?
I do not.
If I were to ask you the same questions that appear in your rebuttal testimony today, would your answers be the same?
Yes, they would.
Mr. Chairman, at this time, I'd move that the pre-filed direct and rebuttal testimony of Dr. Wright be copied into the record as if given orally from the stand.
Dr. Wright's pre-file direct and rebuttal testimony will be entered into the record as though given orally from the stand.
Mr. Chairman, I'd ask that Dr. Wright's one exhibit be marked for identification and entered into the record.
Dr. Wright's exhibit will be marked and entered into the record as hearing exhibit number 30.
Mr. Karen, back to you. Do you have summaries of your direct and rebuttal testimony?
Yes, I do.
Would you please give them to the Commission?
I will. My direct testimony presents Duke Energy Carolinas, LLC's request for recovery of expenses that the company occurred between January 1, 2015 and September 30th, 2018 to comply with environmental requirements for the disposal of coal combustion residuals, or CCRs. Duke Energy Carolinas' request does not include any costs that have been incurred related to fines, penalties, or guilty pleas related to CCRs, or any cost associated with events related to those fines, penalties, or guilty pleas. My testimony also presents Duke Energy Carolinas' supplemental requests for recovery of CCR compliance costs incurred from October 1, 2018 through December 31, 2018. CCR disposal regulations and industry practices have evolved significantly over almost a century of providing electric service from coal-fired plants. During this evolution, Duke Energy Carolinas has consistently complied with the CCR disposal standards that were in place at the time. Based on industry developments that occurred in the 1950s, the enactment of the Clean Air Act in the 1970s, and its amendment in the 1990s, and the enactment of the Clean Water Act in 1972, along with the creation of the National Pollution Discharge Elimination System, or NPDES, permitting program, wet ash handling and ash basins were the primary lawful and effective way to meet CCR needs and the environmental requirements in years prior to the advent of today's requirements. In many cases, ash basins were actually created or relied upon to effectuate prior environmental regulations. With each evolution in these environmental regulations, The company has changed how it's operated its coal-fired stations to comply accordingly. And at each step in this environmental regulatory evolution process, the company has been in line with industry standards and has reasonably and prudently managed CCRs in its coal ash basins. The latest evolution in these requirements, the Federal Environmental Protection Agency's CCR role, as well as state-specific regulations and oversight in the company's service territories, has occurred since the company's last rate case. DEC is now subject to new federal and state regulations that require it to take significant action to modify its operations and, as a result, incur substantial new expenditures associated with those modifications. All of the company's ash basins must be closed under either the CCR rule, state-specific regulations, and oversight, or both. All closure plans must be approved by respective state agencies. The company has begun the process of closing or submitting plans to close its ash basins in accordance with its regulatory obligations. The actions and decisions that DEC has taken in order to comply with federal and state regulatory requirements, including the company's current and future compliance activities and solutions, have been reasonable, prudent, and cost-effective given the individual characteristics of each plant and basin site. This concludes my summary of my direct testimony. My rebuttal testimony on behalf of Duke Energy Carolinas, LLC, responds to direct testimony of Office of Regulatory Staff, witness Dan Whitliff, and SCEUC witness Kevin O'Donnell. No witness in this case have challenged Duke Energy Carolinas' closure strategy for its ash basins under applicable federal or state regulatory requirements, nor have any witnesses in this case alleged that the company has taken any actions that are unreasonable or imprudent. Instead, witness Whitliff and O'Donnell asked the Commission to simply ignore the North Carolina Ash Management Act and its requirements based on their assertion that compliance with CAMA is too expensive for South Carolina customers. I disagree with the recommendation that all compliance costs attributed to North Carolina's Coal Ash Management Act, CAMA, should be disallowed for the company's Riverbend, Buck, and Dan River sites. Like South Carolina and other states in the country, North Carolina has adopted environmental policies and preferences for coal ash disposal that complement federal closure requirements under the CCR rule. Duke Energy Carolina is obligated to follow state regulations and is doing so in an environmentally responsible and cost-effective manner. The suggestion that South Carolina customers can enjoy all the savings of sharing power generation units with North Carolina customers, but can ignore any compliance cost with valid laws would present grave harm to South Carolina customers if taken to its logical conclusions. I also explained that in addition to their misguided proposals to ignore valid CAMA cost, Mr. Whitliff and Mr. O'Donnell's specific proposed disallowances are based on incorrect facts and unrealistic assumptions. First, I disagree with ORS witness Whitliff's erroneous conclusion that, absent CAMA, the company could have left its ash basins at Riverbend untouched indefinitely because those basins are not covered by the federal CCR rule. The provisions that DE Carolinas could or would have taken a do-nothing approach for Riverbend CCR units when similar basins at the company's South Carolina W.S. Lee station that are also not covered by the federal CCR rule where were being excavated is wholly unrealistic. I also explained that Mr. Whitliff has conveniently ignored the fact that provisions in the federal CCR rule that he relies upon to support his do-nothing approach at Riverbend site have been found to be arbitrary, capricious, and without factual support by the D.C. Federal Court of Appeals and have been remanded to the EPA. I also disagree with ORS Whitliff's contention that CAMA's ash beneficiation reuse ash recycling requirement and the associated costs from its Duke Energy Carolinas Buck site and Duke Energy Progress's LLC's HF Lee and Cape Fear sites are more costly to South Carolina customers than the federal CCR rule. In fact, CAMA's ash beneficiation requirements actually result in a net savings for South Carolina customers. And under ORS's proposal, those net savings would all need to be given to North Carolina customers only. Finally, I disagree with Witness Whitliff's contention that Dan River closure schedule under CAMA has increased costs for South Carolina customers. Mr. Whitliff incorrectly assumes that closure could have been started much later at the Dan River under the CCR rule, and this is inaccurate. He compounds his error by assuming that over time, resources become cheaper as demand for them grows stronger, and this conclusion is logically unsound and factually inaccurate. With respect to Witness O'Donnell, his analysis and recommendations of a 75% disallowance of DE Carolina's coal ash costs relies on multiple and analytical flaws and that are each fatal to his conclusion. Specifically, I do not agree with his conclusion in his national comparison of CCR asset retirement obligations, or ARO, amounts shown that DE Carolina's ARO is overstated by 75%. I enumerate 22 factors that Mr. O'Donnell does not appear to have considered, which must be accounted for in order to seriously attempt this type of analysis. I explained that Mr. O'Donnell actually considered those factors. I explained that had Mr. O'Donnell actually considered those factors, he would have discovered that his analysis was invalid. I recommend that the Commission consider the reasonableness of Duke Energy Carolina's ARO amount on its own merits, based on the facts of this case and without regard to Mr. O'Donnell's speculative proposal. This concludes the summary of my rebuttal testimony.
Dr. Wright, do you have a summary of your direct testimony and your rebuttal testimony?
Yes, I do.
Will you please give it to the Commission at this time?
Yes. Good afternoon, Mr. Chairman and fellow commissioners. My direct testimony supports Duke Energy Carolinas LLC, or DE Carolinas, request for recovery of costs related to coal ash disposal expenses that the company has undertaken in response to new environmental regulations. Environmental compliance costs are similar to other costs a utility spends to produce and deliver power, as they are a necessary cost of providing electric service. Specific to coal ash disposal costs, the coal plants associated with these costs have been used and useful in providing low-cost, reliable power to South Carolina customers for up to 70-plus years. Consequently, these types of costs, and if any amount is deferred over time, a return would be appropriately recoverable in rates and consistent with how the Commission has historically allowed recovery of environmental expenditures. The last decade has seen an evolution in coal ash disposal regulations, beginning with EPA's publication of proposed new regulations for coal combustion residuals, or CCR, in June of 2010. In 2015, the EPA finalized those regulations, known as the CCR rule, which represented the first comprehensive federal regulation of CCR. The proposed and final CCR rule also strongly encouraged the states to adopt federal minimum criteria in their solid waste management plans. Accordingly, states in the region, including South Carolina and North Carolina, have developed their own regulations and policies for ash basin closure that complement the CCR rule. The fact that new standards have been established does not mean that DE Carolina's past practices with regard to coal ash disposal were unreasonable. The company's decisions related to coal ash disposal must be judged in accordance with the regulatory standards and industry practice as it existed at the time. To that end, the company historically has complied with all coal ash disposal regulations and industry standards for its coal ash handling operations. Today, these rules have simply changed, and the company must now comply with these new standards. In summary, approval of the company's recovery request is appropriate because these dollars are required to be spent in compliance with new coal ash disposal requirements. That concludes my summary of my direct testimony. My rebuttal testimony on behalf of Duke Energy Carolinas, LLC, addresses several issues related to the recovery of costs associated with coal ash remediation expenses raised in the testimony as ORS witness Dan Whitliff, Michael Seaman Wynn, Gabby Smith, SCEUC witness Kevin O'Donnell, and Sierra Club witness Ezra Hausman. I also addressed general issues on the deferral of recoverable costs raised by Zachary Payne. Taken together, the testimonies of OR witness Whitliff and Seaman Wynn recommend disallowances for ash basin closure costs for all activities that they contend were incurred solely to comply with North Carolina's Coal Ash Management Act, or CAMA. First, this recommendation does not align with the appropriate regulatory standard for denial of cost recovery, including recovery of environmental compliance costs, which requires a finding that specifically identified costs are imprudent or unreasonable. Neither OR witness identified any specific cost as imprudently or unreasonably incurred. Second, this recommendation would overturn sound regulatory policy that system costs be allocated to the jurisdictions that are served. South Carolina customers have benefited from coal-fired generation of electricity for decades. An ash basin closure is a necessary component of that service. If accepted, ORS's recommendation would have a profound and lasting detrimental impact on the sharing of assets between South Carolina and North Carolina and the customers of both states. ORS witness Smith recommends a disallowance of litigation expenses associated with alleged violations of environmental law. It is my understanding that the company is not seeking costs associated with fines or penalties related to environmental violations, nor any legal expenses associated with them. Of the two categories of litigation costs identified by ORS witness Smith for disallowance, one category does not relate to environmental violations at all, and the other category relates to ongoing litigation that the company is reasonably defending where there has been no finding of environmental violations. The company has an obligation to its customers to prosecute and defend those litigation matters, and the associated costs should be recoverable. OR witness Payne recommends that the company not be allowed to earn a return on its deferred costs during a deferral period. For several deferred expenses, OR witness Payne proposes longer amortization periods than DE Carolinas recommended. The Commission should reject the ORS's recommendation because it violates the regulatory compact and that it would not allow the company to earn a fair rate of return on its capital expenses and recover the full value of prudently incurred cost. SCEUC witness O'Donnell recommends that 75% of DE Carolina's environmental compliance costs should be disallowed based on a faulty comparison of alleged National Asset Retirement Obligations, or ARO, amounts relating to CCRs. The Commission should reject any disallowance, especially one as substantial as the amount Mr. O'Donnell recommends, that is not based on facts and evidence that have been proven and verified as substantially significant, and Mr. O'Donnell's flawed proposal fails this test. To do otherwise would constitute poor regulatory policy and would be arbitrary. Sierra Club witness Hausman contends that the Commission should condition the company's recovery of coal ash costs on the future performance of a comprehensive retirement analysis of the company's coal-fired plants. Sierra Club's conditional cost recovery proposal should also be rejected because it violates accepted rate-making policy. It is a fundamental tenet of regulatory policy that utilities be allowed the chance to recover their prudently incurred expenses, and Sierra Club has not shown that any of the company's coal ash costs are imprudent. This concludes a summary of my rebuttal testimony.
Mr. Chairman, this panel is available for questions.
Okay, let me just get a little feel for where we're going from here, about who's going to cross. Ms. Ferguson, do you have cross?
No, Mr. Chairman.
Okay. Ms. Lee? Okay. Mr. Elliott?
Not likely.
Ms. Grundman? Okay. All right. we're going to take a break for lunch, and we will be back at 1:38.